Here's something almost no one will say out loud. 78% of the market's best days happen in the middle of a crash. The fastest you'll ever build wealth could be the next time the market crashes, if you walked in with the right setup. People walk in with the opposite. The next crash will sort everyone into one of those two groups, who get rich from a crash and who don't. In this video, I'll show you the setup that decides which group you land in, a compounding strategy you put in place now, before the crash, so every red day works for you instead of against you. 3 layers, a reserve, a conveyor, and a net that get the system right. Then we run the whole thing through the 2 worst crashes in modern history, and by the end, I'll show you how 10 grand left in the market turned into over $500,000, and how missing just 5 days cut that by almost 40%. Now, that $500,000 comes down to one thing doing the work the whole time: compounding. Most people think the strategy for surviving a crash is the same as the strategy for getting rich from one. It isn't. Surviving means doing nothing. Getting rich means doing something specific before the crash starts. But first, you need to see the engine underneath all of it. Here's how compounding actually runs. You put money in, it earns a return. Next year, that return earns a return of its own. The longer it goes, the faster it moves. It basically feeds itself. So, say you invest 10 grand into something paying 10% a year. After year 1, you're at 11 grand. That's $1,000. Fair enough. But jump to year 5 and you're sitting at $16,105. And that year alone added almost $1,500. Same deposit, not $1 of new money. The base got bigger every year, so the growth did too. Now here's the part nobody tells you. A calm market lets that engine tick along. A crash lets it run faster than ever if you walked in set up for it. Walk in without the setup and the same crash does the opposite. It hands your money to someone else. And that comes down to a single number that almost everyone gets wrong. Ask someone what it takes to come back from a 30% loss, and almost every time they'll say 30%. Lose 30, make 30 back, you're even again. Sounds right. It's also the belief that decides which side of a crash you end up on. Here's why it's wrong. Say you've got 50 grand in the market. A crash takes 30% of it. That's 15 grand gone, so you're sitting at 35,000. To climb back to 50,000, the market doesn't owe you 30%. It owes you around 43%. Here's where that number comes from. The formula is simple. Recovery percent needed equals loss amount divided by remaining balance times 100. And the reason for 43% is simple. You're not climbing back from 50 grand anymore. You're climbing from 35,000. Same 15 grand you lost, but now it's a much bigger slice of a smaller number. And it gets worse the deeper the drop goes. A 40% loss needs a 67% gain just to break even. A 50% loss needs the market to double. A 60% loss needs it to climb 150%. Now here's the part the second group understands and the first group misses. That gap between what you lost and what you need to get back gets called a punishment. It's the opposite. It's a payout. It's the exact slice of wealth that moves from one group of investors to another every single time the market falls. Watch how it happens. The first group sees the 30% drop, gets scared, and sells. They lock in the loss and step out of line. The 43% climb still comes. It just comes for somebody else. Every share they dumped at the bottom got bought by someone. And that someone collects the whole 43% upside because they bought low. A crash doesn't make anyone poor. Selling into one does. Every dollar that panics out at the bottom is a dollar handed at a discount to whoever stayed in line. That's the trap if you're on the wrong side of that handoff. And it's the door if you're on the right side. So how do you actually end up on the right side of that handoff? Not by being smarter than the market, and not by calling the crash before it hits. Nobody does that twice. The people who get rich from crashes aren't guessing. They've got a setup. Money already arranged a certain way before the crash starts, so when it comes, every red day works in their favor. That setup has 3 layers: a reserve, a conveyor, and a net. Each one does a single job. Together, they turn the next crash from a wealth transfer that costs you into a wealth transfer that makes you rich. First, watch what a crash does to someone with none of them. You've got 50 grand in the market. The crash hits, and overnight you're down to 35,000. 2 weeks later, the car dies. $3,200 to fix it, and there's nothing in savings. The only money you've got is in the market. So you sell 3,200 of it at the bottom, fix the car, move on. Here's what that $3,200 really was. If you'd sold those shares at the bottom of a real crash, say the March 2009 low when the S&P 500 closed at 676.53, today it's over 7,500. That's the price alone, climbing about 11 times over. Add in dividends, reinvested the whole way, and $1 left in at that bottom would be worth around 14 times what it started at. So the $3,200 you pulled out to fix a car wasn't $3,200. On the other side of the recovery, it was close to $45,000, handed to whoever bought your shares that morning. Every crash runs the same play. Sell at the lows, and you hand the recovery to someone else. So let's build the layers that keep it on your side. Start with the layer that looks the most boring, the reserve. It's a separate stash of cash sitting in a high-yield savings account, one paying 4 to 5%, way more than whatever your checking account is attached to, enough to cover 4 to 6 months of living. The reserve doesn't grow your wealth. That's not its job. Its job is to keep you in line when the wealth is being handed out. Every dollar sitting in the reserve is a dollar you don't have to rip out of the market at the worst possible moment. And those moments cluster right around crashes. Because the same thing that crashes the market also thins out jobs and squeezes paychecks. The car breaks down in the exact week your hours get cut. Next layer, the conveyor. Money that moves from your bank into your investments on a fixed schedule, automatically, with no decision from you. Most people call it dollar cost averaging or DCA. The name doesn't matter. What it does in a crash is the whole point. Say you put in $800 every 2 weeks. Before the crash, $800 buys you 10 shares at $80 each. Then the market drops 30%. Those same shares are $56 now. Your next $800 buys you 14. Same money in, 40% more shares. Your money buys the most exactly when everyone else is too scared to buy at all. The conveyor doesn't slow you down when the crash hits. It just points your cash straight at the discount and keeps going. Now here's the part everyone gets backward. They think the conveyor is the layer that matters most. It's the exciting one. It's the one actually buying the cheap shares. But the conveyor only works because the reserve is sitting underneath it. Without the reserve, every automated plan eventually hits a real emergency mid-crash. And when it does, you're forced to sell the cheap shares the conveyor just spent months buying. The boring layer is the one holding the whole thing up. Last layer, the net. Spreading your money across different things, US stocks, international stocks, bonds, sometimes real estate. The reason is simple. Different parts of the market fall at different speeds. When US stocks drop 30%, bonds might only slip 4%. International might fall 18%. One part gets hammered while the others barely move. Or in some cases, it goes up, for instance, gold. And that hands you a move most people never get to make in a crash. You sell a little of the part that held up and you buy more of the part that got crushed. Buying low and selling high, without predicting a thing. The net is what gives you something to sell from in the first place. So that's the system. A reserve so you never sell at the bottom. A conveyor that buys hardest when prices are lowest. A net that lets you move money toward the damage. 3 layers, 1 job each. It all sounds right on paper, so let's do something harder than paper. Let's run it through the 2 worst crashes in modern history and see if it actually holds. Let me take you through the worst possible stress test in modern market history. Take someone who starts investing at the single worst moment you could pick. January 2000, the peak right before the dot-com crash. What comes next is the stretch people now call the lost decade. 10 years where the market ends lower than it began. 2 of the worst crashes in modern history hit back-to-back inside that window. The dot-com bust first, then 2008, back-to-back. Anyone who invested a lump sum that January watched it go nowhere for 10 years. Now imagine someone who started running the conveyor in January 2000, $500 a month, every month, into the S&P 500. Worst entry timing imaginable. They watched the dot-com crash cut the account in half. Then they watched 2008 cut what's left in half again. By the end of 2009, they had invested 60 grand of their own money. The account is worth less than that. 10 years of paychecks every single month, and they're behind. That's where the first group quits. It's also where the second group gets made. Because the ones who kept the conveyor running didn't stop at recovering. By September 2018, they'd put in $112,500. The account was worth more than 300 grand. Look at that gap. $112,500 went in, over $300,000 came out. Almost $190,000 of it, the investor never deposited. The market added that. 18 years of automatic transfers, feeding an engine that looked dead at the end of year 9. By year 18, it was the whole story. And that's measured to 2018. The market's roughly doubled since. That's one investor. The pattern behind it shows up everywhere you look. A study from Fidelity took 10 grand, invested it in the S&P 500 in January 1988, and left it alone. By the end of 2024, it had grown to over $500,000. Here's the part that matters. Missed just 5 of the best trading days in that whole stretch, 5 days out of more than 9,000 trading days, and that $500,000 drops by almost 40%. Miss the best 50 days, and you're left with under $40,000. Out of $500,000, 50 days. And here's the line that decides who gets rich from a crash and who doesn't. 78% of those wealth-building days happened in the middle of a bear market, or in the first 2 months of a recovery, before anyone knew the recovery had started. The wealth wasn't handed out on the good days. It got handed out on the days everything looked broken. And the conveyor is the thing that keeps you in line by buying on exactly those days, without you having to make a single decision. It works the same way in a completely different kind of crash. March 2020. The market dropped into a bear market in just 16 trading days, the fastest fall from a record high in its history, and bottomed down 34% on March 23rd. Not a slow grind like the lost decade, a shock crash, and the bounce was just as fast. A new record high by August, only about 6 months after the peak. Anyone running the conveyor through those weeks bought shares at prices the market hasn't seen since. By the end of 2021, the S&P had closed the year at 4,766, up nearly 27% on the year alone, and the shares bought in the worst weeks turned out to be the best ones in the whole portfolio. 2 crashes, a slow one, a fast one, same system. Both made the second group richer, and both punished the first. The entry point barely mattered. What mattered was every month that came after. So if the math is this obvious, and the case studies are this clear, why doesn't everyone end up in the second group? Because the wealth a crash hands out doesn't go to whoever needs it most. It goes to whoever can stand in front of it. And standing in front of a falling market is the hardest thing a human brain has ever been asked to do. A firm called Dalbar has measured this gap every year since 1994. They track what regular investors actually earn against what the market actually returned. The headline almost never changes. The investor leaves money on the table. In 2024, the S&P 500 returned 25.02%. The average everyday investor earned 16.54%, almost 850 basis points behind the market. Take the 20 years through 2024. The market returned 10.35% a year. The average investor got 9.24%. Barely a percentage point apart. Sounds like nothing. Run that gap across 2 decades, and the market's pile ends up worth about 22% more than the investors. That gap isn't fees. It isn't bad luck. It's behavior. The first group sells in the panic of March 2020. The second group buys what they're selling. The first group piles in after a long bull run. The second group already bought 2 years earlier. The handoff happens on red mornings and green afternoons. And it adds up to 22% every 2 decades, over and over. And the cleanest version of this transfer isn't a study, it's a single fund manager. Peter Lynch ran the Fidelity Magellan Fund from 1977 to 1990. Magellan was a mutual fund. One person, the fund manager, picks the stocks for everyone invested in the fund. Over those 13 years, Lynch's fund returned an average of 29.2% a year, against roughly 14% for the market, the single greatest mutual fund run in modern history. Now sit with this. The average investor in that fund didn't come close to 29%. Plenty of them underperformed badly. Some reportedly lost money, in the best fund of all time. Why? Because in any 12-month stretch during Lynch's run, the fund lost money 17% of the time, and every time it dipped, a wave of investors panicked and sold, right before it climbed again. The greatest fund in history was running underneath them, and they handed the gains to whoever bought their shares. So even the best engine ever built couldn't keep the wealth on its owner's side. Knowing the math clearly isn't enough. There's one more move, and it's the cheapest one in the whole system. Write the plan down, on paper, today. Not stay calm, specifics. what you do at minus 20%, at minus 30%, what you do if your job feels shaky the same month the market drops. Whatever you decide today on this page is what you'll read back the morning everything turns red. That piece of paper is what keeps the wealth on your side of the room. If building the setup is step 1, step 2 is deciding what those investments actually are. I built a 5-asset portfolio designed to replace a paycheck, where a $10 a day conveyor belt turns into $5,230 a month coming in without you working for it. That video's on screen right now.